Inflation, a word that you probably heard a lot in 2022, surrounded by a ton of economic information that always seemed to be changing. But what is inflation at its core? Why is it rising in the United States and around the world? You came to the right place, because in this video we'll explain how inflation works and how it impacts each and every one of us. I'm V. Let's jump in and unpack the inflation craziness. Inflation is a loss of purchasing power over a period of time. This means that your dollar won't go as far tomorrow as it did today. It is typically expressed as the annual change in prices for everyday goods and services such as food, furniture, apparel, transportation, and yes, even toys. Rising inflation means everything from groceries to cars become more expensive, and it may be harder to afford everyday essentials. From an investor's perspective, inflation rates rising higher than return rates on your investment portfolio means lower monetary return overall. In simple terms, when prices rise, our money buys less. We could point at a ton of recent events and situations that have all played a role in the increasing inflation that we've seen today. And there's a lot. But it all boils down to the basics: supply and demand. We learned all about this back in our Econ 101 high school class. So let's take it back to the basics and begin with the demand side of the process. Demand pull inflation is when we see an increase in demand for a service or a good, but there's not enough supply to meet the demand. As a result of increased consumer demand of a good or service, prices increase. The issue is simple. People want more of something there is not enough of. Remember in March 2020, at the beginning of the pandemic, everybody wanted toilet paper, which made it harder to acquire. Because the consumer demand for toilet paper increased, so did the price. This is a small case study of demand pull inflation. We also have to consider the supply side. On the supply side, the issue lies within the production costs. This issue is called cost push inflation. Cost push inflation is when the production of something becomes too expensive to make. When the cost of production increases, so does the price for the end result. For example, increasing raw materials could force businesses to raise prices on the goods and services they already sell. If enough businesses are affected and raise their prices, it can lead to an overall increase in prices and higher inflation rates. It is worth noting that not all increases in prices are considered to be inflation. Inflation only occurs when a sustained increase in the general price levels are maintained over a period of time. We measure inflation using two main inflation gauges. One being the Consumer Price Index, otherwise known as the CPI. The CPI measures the cost of things that urban consumers buy out of pocket. The CPI breaks up these goods and services into 8 major groups: food and beverage, housing, apparel, transportation, medical care, recreation, education and communications, and other goods and services. The U.S. Bureau of Labor Statistics reports the CPI on a monthly basis and has calculated it as far back as 1913. The CPI is the most widely used measure of inflation and is sometimes viewed as an indicator for the effectiveness of government economic policy. Everyone from the President, Congress, and the Federal Reserve Board use trends in CPI data to formulate and manage fiscal and monetary policy. When using the CPI as a gauge of inflation, it has some limitations that are definitely worth understanding. The CPI does not take into account all population groups, so data on spending habits of populations that are outside of the urban area may not be included. In a sense, the CPI might not be the truest indication to how much inflation the entire nation is experiencing. The other main inflation gauge is the Personal Consumption Expenditures Index, otherwise known as the PCE. The PCE is released at more of a lag and measures things that people consume, including the things that people don't pay for directly, like healthcare, which insurance and government benefits help to cover. In 2012, the PCE price index became the primary inflation index used by the U.S. Federal Reserve when making monetary policy decisions. These monetary decisions play a huge role in combating rising inflation. As you can tell by now, inflation is a complex topic and it covers a wide range of market sectors. Now that we know a bit about inflation, what causes it, how we measure it, I want to talk about how it impacts us as investors. First, in times of volatile inflation, companies feel it too. Companies often find themselves battling rising functioning costs, fewer hires, maybe even large layoffs, as well as taking on fewer projects. When companies feel the impacts of inflation, it makes it difficult to plan accordingly. Companies that are unwilling or unable to expand may see a decrease in their stock's price. Second, investment returns often take a hit during times of volatile inflationary pressures. When you invest in a stock, you expect an annual return, even in the form of dividend yields. Say that your dividend yield is 3% annually, but inflation is 7%. So now your return is effectively worthless. Lastly, in times of high inflation, the Federal Reserve attempts to combat inflation, as we mentioned before, by attempting to make monetary policy changes, mostly by hiking interest rates. The Fed has increased interest rates several times throughout last year and has plans for more interest rate hikes this year. Higher interest rates create mixed outcomes for different sectors, but higher interest rates have historically impacted stock returns negatively. Consider this: companies borrow money to finance future ventures. When interest rates rise, borrowing money becomes a lot more expensive. Therefore, businesses borrow a lot less. This can cause a dramatic slowdown in growth of a company and weaken any future outlooks that company has. This all directly impacts the company's stock price as well as our personal investments. So yes, inflation does have a tendency to eat away at investment returns. This is why it is crucial for every investor to consider all of the variables at play when investing in times of high inflation. 2022 proved to be another wild year in the markets. We saw all of the insane gains of 2021 ripped away, and we saw a lot of investors punished for being underprepared for inflation to rapidly rise. That's what makes understanding inflation so important. Prepare yourself for the years ahead as rising interest rate and inflation continues to knock on the door of the stock market. Investors should always stay alert and aware of what's happening with their investments. It starts by being equipped with the knowledge we need to effectively analyze our investments with all of the facts. Before you go, I want to tell you about Pluto and explain how it can help protect your investments against market madness like inflation. Pluto allows you to easily design complex, automated trading strategies that work, even when you're not around. Pluto also gives you a ton of risk aversion tools like stop losses and take profits that can completely be automated as well. This gives you a phenomenal opportunity to take your portfolio to the next level without ever missing a beat. Head to pluto.fi for your free practice portfolio. Use the link in the description to get connected to our Discord. We have a huge community of like-minded investors that take part in live discussion each day. On the Discord, we also have weekly giveaways, so check it out. Don't forget to like this video and subscribe to the channel so you can get notified for when Pluto posts. V out.